Let's talk markets and how investors might want to think about the conflict in the Middle East, as well as some of these earnings reports and what's going on. Mona Mahajan is the senior investment strategist at Edward Jones. Good morning to you. Layer on what's happening in the Middle East, but we're also going through the middle of earnings season, and I think a lot of folks are trying to figure out which way this market is headed as a result.
Yeah, absolutely. Look, it's been kind of a harrowing week and a half in the headlines, and certainly our hearts go out to the tragedy that's unfolding in the Middle East. But what we'd say from a market perspective, when you look historically, geopolitical crises tend to be short-lived from a market and investment sentiment perspective. Really in the 3, 6, and 12 months after most major crises, we do see markets actually outperforming and back up above where we saw, when the crisis began. Now, what we'd say more broadly is, as we kind of entered the last week and a half, we did see some glimmers of optimism. That came as, of course, the flight to safety trade in the Treasury bond space really kind of offered some much needed relief to investors as Treasury yields were moving relentlessly higher in the weeks prior to the crisis. So that was one piece of good news. But the others, of course, as we're entering earnings season, we are at an inflection point in earnings in that the last 3 quarters have been negative year-on-year S&P earnings growth, and this could be the first quarter of positive earnings growth.
Right.
Now, keep in mind, this also comes at a time where seasonality is in our favor as well as we enter Q4.
That's my question. We've seen some nice earnings reports, and I don't want to be, negative Nancy here, but the real question is what you think these earnings reports are going to look like 12 months from now. And that's the part that I think is a little bit harder to figure out. Even putting aside, if you can, in your head, what's happening in the Middle East, just where you think we are in terms of, if you believe a recession is coming or you don't believe a recession is coming in 2024.
Yeah, certainly what we see is we've had a tremendous first 3 quarters of 2023. We've seen 2 to 3% GDP growth, which is above trend. We see a deceleration coming from above trend, but really to kind of maybe below trend growth, not negative growth, not 0% growth, still growing, but at a slower pace. And that comes as perhaps the labor market cools and perhaps the consumer faces some more pressures. We know they've worked down their excess savings. We know that they're facing higher interest rates, higher mortgage rates, and they are also looking at an environment where bank lending standards remain pretty tight. So there are some headwinds facing the consumer, which has been extremely resilient. So we do think there is a softening to below trend growth. But we do think that may be welcome from some perspective for the markets because it also keeps the Fed on the sidelines. And we see some of those inflationary pressures, especially in core inflation, start to ease if the consumer does take a breather here. So we think from a market perspective, this will not come as a surprise. Consensus already is looking at a period of slowdown in Q4, Q1, potentially seeing a rebound in the second half of 2024. We think that's a pretty credible scenario. Also coincides with a time when the Fed may not only pause rates, but start signaling, those rate cuts that they've been talking about in the back half of 2024.
What would you be buying then right now?
We continue to see a broadening of market participation. We know this year it's been very much led by a handful of large cap technology stocks. We think the valuations are pretty compelling outside of large cap technology. And not only, in the cyclical parts of the market, but we are looking at areas like small caps over time and even international that could play some catch up. And then, of course, on your bond portfolio or in your bond portfolio, we think a little bit of longer duration, cost averaging in over the next few months ahead of this potential pivot from the Fed really is a pretty compelling opportunity. So broadening in equities, extending duration in your bond portfolio, and not wholesale giving up on that AI technology space as well, because we think there's a longer term secular bull market there, but just waiting for better valuations.